1980s, an era of big dreams, booming businesses, and the American dream of owning a home. But hidden behind this success, a financial disaster was brewing that would cost billions of dollars and shake the entire country. What went wrong? How did trusted banks gamble away the savings of hardworking Americans? And what does this crisis teach us about our financial system today? Because understanding this crisis might just change the way you think about your own money. What's savings and loans? These are special banks that help people save money and get loans to buy homes. They were very popular because they offered good interest rates and they seemed safe. At this time, S&LS were known for offering attractive interest rates. This meant that when you deposited your money into a savings account, you could earn more money over time. Many people loved the idea of watching their savings grow while also having the option to take out a loan for a house. As more and more people began to trust S&Ls, the number of these institutions increased. They popped up in neighborhoods all across the country. S&LS became a central part of many communities, often sponsoring local events and helping families with financial advice. People felt comfortable going to their local S&L because they knew the staff and felt a sense of belonging. During this time, S&Ls were also focused on making home loans. They would lend money to families to buy houses, and in return, the families would make monthly payments back to the S&L. This system worked well because people wanted to own homes, and S&LS had the resources to help them. When the crisis began, by the mid-1980s, things were starting to go wrong. While S&LS had been growing and helping families, many of them began to make some very risky decisions. At this time, some S&LS started investing in bad loans and risky real estate projects. They were lending money to people who might not be able to pay it back. This was a big mistake. When the economy began to slow down, many of these borrowers couldn't make their payments, and the S&LS started losing money. As more S&LS faced losses, the problems started to pile up. By 1989, nearly one-third of all S&Ls in the United States were either in trouble or had already failed. This meant that many families lost their savings and homes. The crisis was hitting hard, and people were scared. They had trusted these banks with their money, and now they were worried about losing it all. The savings and loan crisis didn't just affect banks and homeowners. It had a significant impact on the entire American economy. As S&LS began to fail, the consequences were felt in many different ways. When S&LS started to close their doors, thousands of people lost their jobs. Bank employees, construction workers, and many others who depended on the housing market felt the pinch. With so many people out of work, the economy began to slow down. Families were struggling to make ends meet, and many were forced to cut back on spending. To make matters worse, the government had to spend billions of dollars to bail out the failing S&LS. This money came from taxpayers, which caused a lot of frustration. People were angry that they had to pay for the mistakes of the banks. The savings and loan crisis had a deep impact on the American economy. It led to job losses, a struggling housing market, and a loss of trust in financial institutions.